And here's us, that's me and my wife. What we do, we like to locate emerging markets, locate value-adding multifamily properties. We do the inspections, negotiate contracts, manage the asset, liquidate the property, and then help reinvest in the next property. Some secrets to our success is that we like to buy, hold, and sell during the right marketplaces. And we're going to talk about that in just a little bit. We would like to invest in emerging markets only. We're not going to be investing in slower markets that we have to wait for appreciation to happen or wait for market signals to say that it's a favorable time to sell. And we like to reposition and rebrand the entire building. We implement forced appreciation and build that into our business plans from the beginning. And we like to provide quarterly cash flow. And we only invest in areas that are emerging in neighborhoods in markets that are emerging. So we like to only invest in C+ to B assets in B to A areas. And we'll talk a little bit more about what that grading means. So in order to find emerging markets, we have to find job growth reports. We have to look at population growth. We have to look at real estate white papers and analysis from all these different brokerages across the United States. Berkadia, Yardi Matrix, Marcus & Millichap, CBRE, Newmark, everyone. And then we also look at path of progress reports and look at the latest data that's out there. We're looking at a whole bunch of information from Esri and a lot of different areas from the Bureau of Labor Statistics. And then we're looking at local economic reports and trends. And then, of course, getting in touch with the Chamber of Commerce in each of the cities that we target. Now, if we back up a little bit and try to explain what an emerging market is, an emerging real estate market is a market that has the potential to grow and give appreciation in a 3 to 5 year time frame just by holding the asset itself. And hallmarks of an emerging market is job growth, population growth, new construction, and has the potential to give higher returns because we're seeing a path of progress or there's some reason why it's going to go up. In order to find emerging markets, there's also a timing component that we need to be aware of. Now, in an emerging market, there's a specific time to buy, and it's usually at the bottom or in the upswing from the bottom right now. A buyer's market 1, that's when everything is still oversupplied and the market is kind of hitting its equilibrium, coming down from its peak. In buyer's market 2, that's when the buyers have control of the market completely. They're the ones that are setting prices and setting terms, and it's usually at the bottom of a market cycle when pricing is weak and economic data is cynical. And then seller's market 1 is the ideal time to be able to sell the property. Sell or buy, I should say, the property. Because buying and selling in this particular market allows for some meat on the bone for whoever's going to take over the property after you. And when you buy the property, there's still plenty of runway for you to enjoy that appreciation on the upswing in that particular market. And then, of course, seller's market 2 means that you're topping out and towards the top of the cycle. And it's time to either get out and make sure that your investment is protected and you can sell adequately with enough time so that the next investor can make a profit and they're motivated to buy from you. So that's the timing that we like to be in. And just remember that there's a national cycle and then there's cycles for each individual city as well. So all cities across the United States have a different timing and they're on different types of market cycles throughout the country. All right. And in order to find the specific properties themselves, we tell our brokers that we're looking for motivated sellers, bad management, low rents, deferred maintenance, burnt out landlords, the opportunity to implement RUBS, and condo option conversions. Those are high dollar, high value add components that, if we're able to implement successfully, mean great returns for our investors and ourselves. Now, as we were mentioning before, there are different types of classes for multifamily property. Type A is the luxury newer builds that are new construction and almost have this swanky feel to them. It's like it's right in the middle of downtown. You don't even have to have a car. You can just walk outside and you're next to the theater, or you can go to the grocery store. You don't even need a car. And it's recommended that you don't even have one, because most times there's no parking, or if it's a really nice A-class property, there's plenty of parking underground. So these are usually in areas that are brand new and super up and coming and very, very valuable. Now, type B tenants and type B class properties are properties that are a little bit older, more in the suburbs. They have more space, they have more parking, and they're just those really, really nice looking spread out apartment buildings that are kind of sprawling. Everything is kept up well, and most of the tenants in there prefer space, and they like quiet. And there's usually a mix of white and blue collar workers who can afford it, and is generally in a good location where we have a good opportunity to keep the value going and keep the value rising as it is. And then the C class are a little bit older than B, where it's generally blue collar workers. Some of the buildings may look a little bit run down or have some deferred maintenance to fix, and maybe they're motel conversions, but they're in good areas or in areas that are on the upswing in the next 3 to 5 years. These are great buys for cash flow. And then, of course, there's the class D, which is just the war zone buildings that are absolutely falling apart and kind of in a situation where there's crime all around it, and no one really wants to live there, and everything is breaking down. So these are really, really tough buildings to turn around, and you have to really know what you're doing if you're going to buy here. And at Elevate Equity, we like to buy in the C and B range because we feel that there's room for tenants to move from the D to C range in some of our properties there, or to move up from C to B, or they can move down from A to B or from B to C whenever there's an economic situation, or a tenant by tenant situation calls for a reduction or a downsizing, or maybe a tenant gets a raise and wants to increase the size of their family, so they want to move into a bigger space in a nicer, safer area. We want to make sure that we give those tenants our options in B and C class buildings and areas.